code is easy, distribution is hard. Token doesn't necessarily mean product market fit either. Airdrops don't mean retention. Yield doesn't necessarily mean utility.
Hey everyone, welcome to the Smart Economy podcast, where we ask your favorite builders the questions you wish you could ask yourself. This is a production of neonewstoday.com, and I'm your host, Dylan Grabowski. In this episode, we're joined by Aryan Sheikhalian, the head of research at CMT Digital, a blockchain and Web3 proprietary trading and venture capital firm focused on early-stage investments that accelerate the adoption of blockchain technology. In this conversation, we discussed Aryan's introduction into the blockchain technology sector when he was in college, the early years of CMT, and how the CMT Digital subsidiary evolved in the post-Silk Road auctions, the stage of projects that CMT Digital likes to invest in, the role that VC plays in blockchain industry's maturation, key takeaways from the past 8 years, and so much more. Just a reminder, nothing said on this podcast is a solicitation to buy or sell any tokens, and that the guest or host might hold tokens discussed in any given episode. You can check out a full disclaimer at www.neonewstoday.com. If you enjoyed this episode, please rate and review it on your favorite podcasting platform, and don't forget to share it with friends and family. Every rating, review, like, comment, and share helps us reach more people and bring you more of your favorite guests. I really enjoyed this conversation with Aryan, and I hope you enjoy it too. Hey everyone, welcome to the Smart Economy podcast. Today we're joined by Aryan Sheikhalian, the head of research and investor at CMT Digital, a VC firm that is investing in early stage blockchain projects. Aryan, how you doing today?
Hey Dylan, great to meet you, mate. Thank you for having me on.
Absolutely. I think before we hit record, I was mentioning how excited I am to have someone from the VC realm come back on the pod. It's been a couple of years since, and I personally like having conversations with VCs because VCs bring a completely holistic and different perspective to the industry and the market than maybe someone building a dApp or an engineer or even a crypto trader or anything like that. So with that caveat and everything kind of like out of the way, let's just take a step back, and I love to ask this first question as we jump off into the pod. What's your genesis story with crypto? When did you first hear about Bitcoin, blockchain, crypto, Ethereum? And if you're anything like me or 90% of our guests, you just kind of like looked past it, and then you had an aha moment later. So what was your aha moment?
I first learned about Bitcoin and crypto back in 2015-16 timeframe. It was I was working at Accenture as a management consultant, business analyst over in London. And I was working with a number of financial services firms, and they were doing change management. So kind of, firewall upgrades on ATMs, things like that. So not particularly exciting. But my implementation partner on the stakeholder side was a cryptography Bitcoin fanatic, got me into the space. I started reading about Bitcoin. One of the first books I read was Blockchain Revolution. And so when I went over to America, I came here to study. I started, reading about the technology. I wrote to Don Tapscott, who was the author of Blockchain Revolution, and Jenna Pilgrim I met through the rowing community, and they brought me on as a intern in my freshman year, and that's how I kind of got introduced to the space. This was around the ICO era, and so looking into kind of use cases of blockchain technology, and at the time I was studying economics and mathematics, and in mathematics, the part that I was specializing in was cryptography and kind of distributed systems. And so I started thinking about, yes, Bitcoin is one application of distributed computing here, but really where can it go from here? And that was really the rabbit hole for me. So started reading about mechanism design for consensus mechanisms. That's where I was writing on with the BRI, and then DeFi and how it could kind of transform the traditional finance landscape.
Very cool. Were you brought on to Columbia to be on the rowing team?
I was recruited.
Okay, I have a question. The Heart of Champions, a film backed by the Winklevoss brothers. Have you seen it?
No, is that to do with Boys in the Boat?
Yes, it's a rowing movie and it's completely out there and ridiculous. But the Winklevoss twins funded it because they themselves were in the rowing community before they went onto Facebook and do what they did.
Right, right. I should definitely check that out. I haven't checked it out.
Yeah. Get ready to be angry from what I've read from the rowing community. Very cool. Let's like take a step back then and share a little bit more about how you ended up at Columbia. Was this for postgraduate? Was it for graduate school? Did you go there to study computer science? What was kind of like the draw to wanting to study there in addition to being on the rowing team?
Yeah, for me, it was being in the city. New York City is obviously, a great entry point to the United States. And as someone coming in, I thought that was a great place to spend my 4 years undergrad. So it was undergrad. I knew that I wanted to study economics and mathematics. I knew that that is what I wanted kind of the core of my studies to be around. And Columbia did offer a joint economics and mathematics program, which I found really compelling. I also did find the core curriculum quite compelling. That was kind of this more holistic, well-rounded education in the liberal arts. And, if I wasn't compelled to do it, I probably wouldn't have. So it was a good thing that I chose Columbia. But being in New York, back in 2017, after I got back from the Blockchain Research Institute, I helped co-found the Blockchain Club at Columbia. And in the early days, it was useful being in the city to be able to access all the events that were happening downtown. And yeah, if it wasn't for the city, I'm not sure if I would have had that same level of early exposure.
And what was the general excitement about the blockchain club at the time? I would imagine since we're talking 2017 ICO era, there were probably a lot of interested people. In 2022, I went to a wide variety of universities across the US to go talk about building careers in Web3 and spoke with blockchain clubs in the Midwest, along the coast of California. And there was a lot of hunger, and this was kind of like during a bearish time. So it was refreshing to see students wanting to build in blockchain and Web3 during the 2022 bear market. What were the vibes like when you started the blockchain club, and is the torch still being carried today?
Yeah, well, I mean, the torch is very much being carried today. The folks over at Lion DAO and Blockchain Club of Columbia have just been, moving the club forward in a way that I couldn't have even envisioned at the time. So one of the first meetings that we had was in fall of 2017. So this was right after that summer. Things were kind of peak euphoria at the time. There's only a few classrooms on campus that can actually have capacity for a large number of students at the kind of for a club level. And so we booked out one of the rooms in the math building on the lower floor, one of the largest classrooms. And there was like standing room only. There were hundreds of people who showed up for the first meeting. And then we broke for winter and the 20,000 Bitcoin peak happened and then it crashed. And the first meeting back was like crickets. It was like maybe 10 people. And so, yeah, definitely the attendance followed the price action in the early days. But, seeing how the group came together more and more frequently afterwards and has obviously carried on past individual cycles, it really thanks to the folks like Nir and, Adrian and, all the folks that carried on the club after its initial forming, that we have to thank.
Have you been brought back on as like a speaker for events or anything like that?
Yeah, I think it was Lion DAO event in New York, and I was on the past president's panel. That was awesome.
Yeah, that's awesome to come back to your alma mater and kind of espouse the ways of working in this industry. Do you recall during the time if your professors were skeptical of the technology? Were they more focused on like Bitcoin as an asset? Because a lot of skepticism I've heard from academia has been more tied to the price action and its volatility, and that kind of overshadows the technology and the innovation that it represents.
Right. And I mean, perhaps I was a little bit too early to be able to feedback, because when I was studying, there wasn't a huge number of classes that were available in blockchain. A lot of them were kind of geared towards the business school. I've connected with Siamak from Columbia since, and he seems to be doing some great work there in getting kind of more crypto native thought around the topic. But, I think it's something that people have started out very, very pragmatic in the academia kind of realm and have become slowly more and more pilled on the topic. And so I think we're at a healthy medium where obviously academic rigor with distributed computing goes back decades, and a lot of the foundations are still rooted in theory. And so there's no reason for that to change. It's just a question of applications of the technology and how that's covered. And I wouldn't be able to tell you.
I wonder if the pipeline, and this is probably a speculative question, if the pipeline has gotten a little bit more solidified or become more amalgamated as we've seen TradFi institutions start to build out their L2s. We see TradFi institutions start to create financial instruments that are baked around these digital assets. I just wonder if like business schools are starting to funnel more students into the Web3 space because we are seeing this kind of, I don't know if it's the right way of like a stamp of approval from historical institutions, but for lack of better words, that's essentially what we're seeing, especially in the past year or two with the Bitcoin ETFs. I'm not sure if you can even provide an answer or have any insights to that.
Part of me says yes, just because of visibility, right? And I think while you're in further education, I think accessibility or perceived acceptance of some technology is important as a kind of predicate for getting involved. But when looking at some of those ETFs or instruments that are being created, they're not necessarily leaning into the full value of what blockchain technology or cryptocurrency technology can actually provide. It's all very much enshrined within the existing system and existing structures. And of course, that's a stepping stone, but it's not really ushering people into, crypto native applications. It's more kind of the adoption life cycle, which I think is equally important, but ultimately a different angle of attack.
Yeah, I was actually having this conversation last night with somebody where, maybe this time in this market cycle is different because in previous market cycles, we would see kind of Bitcoin accrue all this value, and then that would leak out to altcoins, to other Web3 verticals because profits were taken and they were distributed into other ecosystems. And maybe we don't necessarily see that because as we've seen in the past year, kind of Bitcoin rallied largely probably due to these ETFs, not financial advice. I could just be pulling all of this out of thin air. But this has been my speculation that the Bitcoin price has appreciated because we've seen a lot of TradFi institutions acquire Bitcoin. However, it's been in this kind of TradFi wrapper. And so it feels like it's almost moated off, or it's like stuck behind a moat from the rest of the Web3 space. So maybe this time is different because we won't necessarily see these gains and these profits be taken off the table and distributed into NFTs, L2s, what have you. And so I wonder if maybe this time is different because a lot of this value is kind of like encumbered within a TradFi wrapper.
Yeah, for sure. And I think that's part of Bitcoin's story of finding product market fit. I mean, Bitcoin's product is being the ultimate kind of protection against currency debasement. If that product had found product market fit in cycles past, we wouldn't have seen that leakage to altcoins. And so I think if Bitcoin's kind of value capture and the lack of an altcoin cycle that we're seeing this year is reflective of that, then I think that would make sense. I mean, institutions aren't going to take profits and rotate into Milady NFTs, but individuals may. So I think that makes sense.
Yeah, institutions aren't here for the culture yet. So before we kind of like get into what CMT Digital is doing, I did just kind of want to touch really quickly on your tenure at Blockchain Research Institute. How did you get connected with that team? What were you working on? And then how did that kind of like funnel you into being in the space full time?
Well, I mean, I got connected to the team. So shout out Jenna Pilgrim from Coin Fund. Her and I became friends through the rowing community. She was also a rower. And I expressed my interest in the space, and she connected me with Don Tapscott, and that's how I started working at the Institute. At the beginning, it was very much, try and absorb as much as you can, learn about ICOs and learn about EOS and ICP. And, it was interesting. And that introduced me to, so the first research that I did with them was on how mechanism design impacted a rollout for these projects. And in the early days, there was obviously a lot of experimentation on consensus mechanisms. And so the research was basically looking at, 2,000 or so different projects with different consensus mechanisms and running regression analysis on mechanism design. So looking at, for consensus itself on a scale of 0 to 1, how decentralized is consensus? Is voting a black box or is it delegated proof of stake? So all of these different design choices that you can make for consensus, we kind of laid out and tried to find significance when it came to long-term price performance, traction of the project. It's interesting because the only thing we found significance at was governance at the 5% level. So if there was governance inherent or present, then the token was likely to perform better. But a lot of the time, the governance wasn't actually implemented. It was just kind of touted or marketed. And I think that's interesting because some things never change.
What happened then? Because I remember in 2017, it was if you had your white paper with your consensus model and TPS kind of shilling that, then that was the killer kind of thing that would attract people to coins. And today in 2025, we rarely hear about consensus mechanism. We rarely hear about TPS and the throughput of the network, unless, of course, you're talking about Solana. So, like, where did that go? Did we just, as an industry, mature beyond this kind of like single thing that was super impressive about distributed networks? Or is it just kind of swept under the rug now and just a minor part of what people look at when they're looking to build on these networks?
Yeah, I mean, I do think it's a minor part now. I do think it is obviously still a major part of the decision when you're looking at kind of what environment to exist on. But the reason I think it's become less of a important consideration is because we haven't really tested the upper bounds of these things, because there hasn't been application activity that's broad enough to actually, justify one TPS over another. And I'd say that becomes more of an important conversation when we do start reaching those upper bounds. And kind of parts of my thoughts around Ethereum's future kind of lie in this kind of direction specifically. Ethereum has all of these applications building on top of it and making use of its block space. To what extent can it actually provide value to those applications in the long run? And it's not as a result of higher TPS, like offloading to someone like Monad, at least today. And so it's a question of which comes first, the environment that can support that high throughput application, or the high throughput application, which then necessitates the environment.
I want to delve into that a little bit later as we kind of like jump into general trends or kind of like general blockchain conversation levels in 2025. But let's first figure out how you got connected with CMT Digital. You're based in Chicago. Is the team based in Chicago? How did this relationship form?
Yeah, so CMT Digital is based in Chicago. I'll give you an intro to the CMT Digital group a little bit more in depth here. So one of my roommates in college was actually from Chicago. I visited in like sophomore year for Lollapalooza of all things. And for me personally, New York was getting a bit too much. I wanted to move to a city that was a little bit more manageable. So I'd fallen in love with Chicago since sophomore year. I knew that I wanted to come out here. I was looking at different opportunities within the space, and Chicago was one that I was actually gearing towards specifically. So got connected to the CMT team. Colleen was still here. So Colleen Sullivan and I spoke, and I met Sam and Charlie shortly thereafter on our team. And I think it was just a very good team fit. I found the people here really curious, humble, and kind of highly, highly aware of the opportunity at hand, and being able to explore that in a way that is open to these radical ideas, in a way that's not necessarily encumbered by traditional methods was really encouraging. And, CMT has this history of being a really nimble firm. It was established back in 97 as a proprietary trading firm. So it came out of the electronic trading markets opportunity. Originally, it was established in Frankfurt, Germany. We still maintain those trading activities globally today, but as a trading firm, I think its history has always been rooted in opportunistic engagement. And so in 2013, during the Silk Road auction, the team here saw something unique. How is the US Marshal Service selling Bitcoin in 2013? So I think it was seeing that unfold, thinking about the ramifications, and making proactive steps of joining something like the Blockchain Association, which they did really early, and kind of becoming engaged in those early policy discussions really set up the team to engage in a way that would have otherwise been pretty difficult.
So I'm curious then, in 2013, is it just like a small kind of portion of CMT that was set aside to kind of look at this emerging asset class and this emerging sector? Or was this from the top down kind of a general consensus within the entity that blockchain and crypto is something that we're going to look into?
Well, that was it, really. It was Jan and Scott, the founders of the firm, looking into it and seeing the opportunity with Bitcoin and deciding that it is going to be a big portion of the firm's future. And so then that's when CMT Digital was actually established. Initial investments were made around 2015. The crypto trading desk was spun up full time in 2017. And then they acquired the RIA from the SEC and launched the first venture fund in 2018. So yeah, it was very much a proactive from the founders down that, yeah, this is something that we're bullish on and we want to be part of this broader market transformation.
So pardon my ignorance, is CMT Digital the entire parent company, or is this kind of like a subsidiary of CMT?
Yeah, so CMT Digital is a subsidiary of the CMT group.
Perfect. Yeah, because if you go to cmt.digital, the tagline is backing extraordinary founders building on the frontier of blockchain innovation. Hell of a title, hell of a of a lead in. So what is CMT Digital predominantly focused on today? And at what stage of a project are you guys looking for to invest into teams?
Pre-seed seed is kind of my main focus. Obviously, we look at Series A, Series B as much as we can, but we're targeting, ownership early in these companies. And I think given the landscape and given how many different funds there are, I think that necessitates us to engage and become convicted earlier and earlier, or as early as possible. It's important to note that I think since the founding of the firm, the market has gone through so many different cycles and the types of businesses that we're investing in are changing. And so kind of early engagement, we were investing into the picks and shovels, things like FalconX, things like kind of Consensus, some DYDX, some of the early kind of adopters. But obviously as that shifts, as the market matures, I think it necessitates investing in other areas. So as applications become more and more viable, looking at the application stack, or if engagement with the TradFi industry starts deepening, looking at infrastructure tooling that could support acceleration there. I think it has to be a dynamic and proactive engagement strategy or investment strategy, which isn't necessarily the same all the time.
I think for anybody who's been in the space since 2015, 16, 17, 18, there's probably a lot of earned cynicism from just hearing nonsense shilled year after year and promises made that were never kept. And I remember 2017 ICO era, you had decentralizing everything. We're going to decentralize Uber. They raised $18 million. We're going to decentralize Airbnb. They raised $12 million. And these teams never delivered. And I think like if you've been around for 5, 6, 7+ years, you kind of get grizzled and maybe you don't have the same faith in a utopian future that this technology can offer. But now in 2025, it feels like for the first time that blockchain and distributed storage or distributed systems can deliver something unique. So are we finally there? Are we finally at the precipice where large promises can be made and maybe they can even be kept? Are we at the point in this technology's life cycle where a decentralized application can actually provide more value than its centralized counterpart?
I think this is a really important point. One of the things that I like to emphasize is that, and you're completely right, decentralization has become a bit of a meme, especially for those of us who have been in this space for many, many years. I like to say that we like to invest in decentralized systems with pragmatism, or decentralization with utility. So we have a strong preference for protocols where decentralization isn't just this ideological target or this kind of signal, but more of a functional necessity. Let me give you an example, like AI. And I know AI has become incredibly, it's filled with all of these jargon points and mimetic engagement. But the point is that the data used for training does kind of exist in this distributed fashion. So does the compute is also accessible in a distributed fashion. If the data and the compute both naturally exist in a distributed fashion, if you could make it possible for decentralized training to be as performant as centralized training, then it would position the data and the compute access much more favorably than centralized access. You'd be able to access the same level of compute and data far cheaper, purely as a function of where that compute and that data already sits. And so obviously so much research has to go into that. Noose Research is doing great work with things like Distro, but the pragmatism is holding us back and getting involved until we have a clear picture of how that compute and data access problem is going to play out. But I think for some deep in applications, rethinking how infrastructure works just in the world, I think proximity to a viable decentralized product is much, much closer. And that's when we start thinking about things like telecom. Think about the capital expenditure that had to go into building those early telecom towers. If technology has moved forward in a way where something like helium can be as performant using alternative infrastructure like these hotspots, then that does start to become viable. And so I think that's where we're looking specifically. We're looking for where decentralization comes with an immediate utility unlock that can look to kind of risk the incumbent's business model.
I'm wondering if, because we always talk about onboarding the first billion users into blockchain networks, and people just don't care about centralized entities that own their data. We've seen all sorts of credit agencies leak information. We've seen major corporate conglomerates leak our private information. I'm pretty sure everybody today is used to getting scam text messages and scam calls from some of their data that was leaked onto a blacklist as long ago as 10 years ago now. I remember my first major hack was the Equifax hack. We, as a society, still just don't care about owning our own data, maintaining, this ability to choose who we want to give our data to. And I'm just wondering if maybe I put on my speculation hat a little bit. We could be at the precipice for society starting to care about something like this when we grasp how significant an entity like ChatGPT having access to all this data and being able to leverage its own internal LLMs and its own internal AI compute systems, when we realize how powerful a centralized entity like this can become, do you think like this is like a Mr. Robot moment that could scare society into caring about decentralized solutions and into owning our own data and maybe even like sovereign identity solutions? Or are we still kind of like far away from mainstream caring about this stuff?
I mean, I see two paths forward. Either users gradually, slowly start to care about decentralization when they experience a centralized failure for themselves personally. And obviously that's going to be a slow, linear adoption cycle where, individuals are either the victims of a hack or a data breach or data exploitation, and they just decide, enough is enough and I want to evaluate alternatives, and at which point, decentralized systems can provide a viable alternative. Sure, I see that as one approach. I do think that there is a kind of structural shift that could happen with AI if decentralization can slot in to current systems. So for example, if decentralization can replicate centralized systems, but invisibly and impactfully, like if you can then solve real problems as a result of you having ownership of your own data. And that is such a broader post-market transformation reality because you have so many different industries then being able to collaborate. I'm assuming that one of the main benefits of owning your own data is the portability or the composability that comes with it. And for that to happen, you need to have, market transformation, not just in one vertical, but broadly. And so I think that's as a result of, communities, developers, but also policymakers. And who knows what sort of policies could come out of AI. I also think one of the most important points is the rails, the financial rails. And that's one of the most exciting things about what's happening today in the market. If you have a broad financial rail shift from TradFi stablecoins to DeFi stablecoins, I think that changes the adoption lifecycle for other decentralized systems. Because going back to the point of, why is this decentralized? For any decentralized application, I think they need to answer, what benefit does the user get from this being decentralized? And is the user able to access this decentralized infrastructure? And a lot of the time, the benefit of decentralization is around incentive coordination. And for incentive coordination, you need a viable, scalable way of coordinating those incentives, which is, for lack of a better word, money. And so stablecoins being ubiquitous with TradFi definitely accelerates that, in my opinion, because it enlarges the pool of participants.
Yeah, so we actually just saw here in the States the Genius Act get signed into effect by President Trump. So what is the significance that this has on the industry? We won't see any kind of like rubber meeting the road probably until 2026 when these laws are enacted and come into effect. But what's the significance of this moment? A lot of people who are probably like OG cypherpunk Bitcoin diehards probably are thinking this is a big bootlicking opportunity where we have stablecoins representing the US dollar, increasing the hegemony of this fiat currency being distributed across the world on a brand new technology rails. You might have a lot of cynicism from OGs, but stablecoins are probably the killer crypto use case and have been for the past 2, 3, 4 years, maybe even. So what's the significance from your perspective of the United States finally enacting some stablecoin legislation and having a pro stablecoin outlook now in the US? And how does that emanate to the rest of the world and into the work that you do?
It's hugely impactful. We've been waiting for this sort of legislation as an industry for many, many years. For them to be signed or announced on the same day, I think was pretty impactful as well. There was a lot of euphoria there. I think it comes down to what the US's motivation is. And it's becoming increasingly clear to me that a huge benefit to the US is dollar hegemony, in the sense that they do need to maintain kind of the velocity of the US dollar. And this is such a elegant way of exponentially increasing the velocity of the US dollar, or giving an access to people who would want to trade in US dollars. But it's expanding it outside of the jurisdiction of someone like Swift, which is pretty interesting considering that's never really happened before. And it's happening at a time when other countries are talking about BRICS and alternative currencies. And so I think it makes sense from that sort of policy perspective. And that's perhaps why we're seeing this shift in the outlook. I also do think it's important for US tech supremacy. If applications who come out of the US are going to continue leading the way forward, I think they need to do so under regulatory environments that are favorable to them. And I think that was just a swing back in terms of policy outlook under this administration.
Feel free to, if this is too policy, too macro, or just outside of like the general realm in which you have an insider opinion on this, but when we saw, and not to get too political, but when we saw Russia invade Ukraine, the US responded by sanctioning Russia and kicking them off SWIFT. In my perspective, that was kind of doing something that the world thought was unthinkable. The US kicking off a superpower off of the payments rails. And so to me, that was a point of no return. And ultimately, it seemed like blockchain rails were going to win because they were this permissionless, borderless network in which anybody can transact on. So was the result of removing a superpower off of SWIFT, did that kind of supercharge blockchain-enabled international payment rails? And was it almost inevitable that we were going to have pro-stablecoin policy in the US? And again, if this is like out of your wheelhouse, please feel free to let me know and we can move on.
It might not have necessarily supercharged blockchain payment rails specifically, but I think it definitely reframed, in a way, how the world thinks about financial infrastructure. I mean, the significance is really, this is like, what was it, the first G20 country that was pulled off of the system? And SWIFT obviously was seen as neutral plumbing in the sense that it was financial infrastructure that anyone has access to. But at the same time, we saw China moving towards more of a CBDC type program and CIPS integration. And we saw sanctioned and non-permitted nations began exploring that kind of Bitcoin mining, as we saw in Iran and USDT settlements. I don't think it supercharged blockchain payments equally. I think narrative and legitimacy wise, yes, crypto saw a boost. On-chain FX saw an increase in adoption. Stripe, PayPal, Visa obviously started getting involved, but we haven't seen full-scale migrations of global trade settlement to any sort of blockchain yet. And Russia has began kind of engaging with China on settlement in bricks as opposed to any sort of blockchain-based system. And so I think things like liquidity, regulation, and compliance are still somewhat gating factors when it comes to that broader transformation. It's just, I think it accelerated the perception of the financial rails problem that existed.
Cool. Let's come down from the 10,000-foot view a little bit and talk about your day-to-day at CMT Digital. So what's your specific role at CMT Digital? What are you doing on your day-to-day? Who are you predominantly interfacing with?
Yeah, so day-to-day, looking at projects that are building in the space, looking at investing in them, diligencing them, but also more broadly, looking at thesis formation, looking at kind of what is changing in the landscape, how do we expect potential changes to shake up the industry, things like restaking when they came out, looking at kind of the future of Ethereum here today, for example. Those sort of broader market questions are the ones that I like to engage with early and kind of build out a thesis on, because I do think it's important to have a fundamental thesis when you're looking at investing in some of these longer time frame opportunities.
Yeah, I was just commiserating with my chiropractor today. He's an OG, and one of the group chats we're in is full of these folks who like to make grandiose speculations but never like to do postmortems on the speculations that didn't slap. So what's kind of the process for you and your team to look back on your theses, maybe from a year ago, from 3 years ago, from 5 years ago? And what's the process of iterating on top of the things you got right, but as well as identifying and fixing the things in which you got wrong?
Yeah. So, I mean, we have annual offsites specifically for this, and we actually just had one. So fresh, I'm coming to you fresh. We basically look at the theses that we had in the past and investments that we made with specific theses and evaluate kind of what we think went right, what we think went wrong, how that affects our outlook on the future of this specific thesis. But I also think it's important to talk to other folks that are really boots on the ground. I think there's a lot of different, obviously different investment firms, but also researchers at other protocols. And I feel like researchers have a bit of camaraderie between us and things like, the OX research group from Blockworks. Researchers tend to coalesce around these kind of rabbit holes and find each other. And so the researching community, I think, is one of the ones that I value most in the space, just because they are always in the weeds and they're always looking at these topics. I think a thesis that's really kind of interesting to look back on is within DeFi, for example. Last year, Matt and I from our team were looking at composability and looking at modularity within DeFi building blocks. Things like Euler and Maple became kind of core positions, liquid positions for us as a result of that research of what's going to give them the edge over incumbents. Well, it's the ability to plug into one aspect of it in a modular way and composability with existing infrastructure. And we kind of wrote a whole piece on it. It is actually starting to play out, which is hugely encouraging. That obviously is not necessarily always how it happens. Some of the theses that we have are far too early. Some of them are just not going to pan out the way that we envision. And so I think it's important to have a thesis, but also not be hyper rigid on this is the only way that things are going to go. It's about monitoring how that thesis is developing and reframing it if necessary.
I love seeing Maple's success. Today we had Sid on the pod in maybe 2022, very early 2023. And it's really cool to kind of see how their RWA thesis was indeed correct and how it's playing out. And it's just super cool to see projects survive and thrive years after we've had conversations with them. I want to lean into kind of a question about the role of VCs in the industry. But before we do that, maybe as a launch pad or diving board into that question, maybe we can just talk a little bit about how CMT Digital structures its deals or forms its relationships a little bit different than your competitors.
Yeah, I mean, we like to engage. What we like to say to founders, we like to engage in any way that you kind of see best. Now, there are certain areas where we feel like our support can be more impactful than others. We can look to engage on kind of the trading side, looking at whether the token model makes sense to us, whether the trading strategy, the token strategy makes sense. I personally like engaging with the mechanism design piece, whether it's protocol mechanism design, whether it's a order matching engine, whether it's, Oracle robustness, whatever it may be. That's kind of where I like engaging with the founders super, super early. Just because I think there's so many different design choices you make at the beginning of a project. And a lot of the time, especially within blockchain systems, you have to be very careful about those design decisions because they're not immediately reversible. And so something like Deepin, where the token emissions are really an initial bootstrapping mechanism for the hardware and for the infrastructure, I think it's super important to make sure that you have the balance of what you're willing to pay for that hardware onboarding in mind, because that's going to be your emissions for the at least next few years for the project. And if that's too extractive, well, then that leaves you with a situation that's not ideal when it comes to the, incentive alignment in the long run. With Deepin projects specifically, incentive alignment is paramount when it comes to sustainability. So yeah, I think leave it up to the founder, but engage where you think you can be most impactful.
I think you're kind of leaning into one of my arguments for why VC is such a valuable part of the blockchain and Web3 space in general is the inherent knowledge and connections that you're able to help bring to a team, especially like an early stage project that's trying to formulate all of this. But if you go onto crypto Twitter and you see a lot of anons, there's a lot of hate towards VCs. Maybe one of the reasons, probably the biggest reason, is this perception of access to early token allocations, pre-sale deals. And to many, it can be seen as a lot of these deals are being made behind closed doors, and that once the token hits the public market, the VCs are all going to collude and dump on us. And so that's kind of where this negative sentiment for the VC space in general, from my perspective, as a neutral observer, really does play out. So what is like the role that VC plays in blockchain's development today, in dApp development today, in architecture today? And if you could identify some of the negative perceptions, what are the ways in which they might be erring towards a little bit of truth? And what are the ways in which outsiders might just have it completely wrong?
I think it's also, first, we should preface by saying that not every fund is going to look structurally the same. They're going to have different LPs, they're going to have different mandates, different ways of seeing the world, and different timelines to realization. I think this is really important because, so for example, we have a pretty long timeline, something like 7 years for our fund. And when we look at engaging with projects, it's not necessarily on an immediate kind of early liquidity basis. We're looking at kind of like a traditional exit in the sense that why would we be able to get out of this position in a favorable environment? Are they going to be able to find product market fit at the time where we vest? And I think those sort of questions are more important than when do we get access to liquidity? Because if you get access to liquidity and there's no one there on the other side, for them, that doesn't really make sense. And ideally, you want protocol participants, whether they're on the supply or the demand side, to be on that receiving end. And part of the problem is the project's liquidity cycles have been based around speculation and not adoption. And I think that's where the imbalance between the retail and the venture kind of markets can come in, because retail is supposed to be adoption. But if retail is just farming, that's not real adoption. And so the token model won't really make sense. So I think it's about timelines to realization, kind of an original thesis for engagement and timelines to realization from a fund level, but also looking at kind of what sort of environment will this token be launching into? Is it going to have product market fit? Yeah, will it make sense for the broader community?
Do you think we're seeing adoption actually start to play out? I think for like Solana, meme coins was adoption. You had to have Sol in order to launch these meme coins. And is that the utopian future we were promised in these white papers, that people were going to be trading shit coins? No, but that was adoption. So are we starting to see like real meaningful adoption start to take place? And it doesn't necessarily need to be like world changing, but I do want to hear if like the ticker is moving into the right direction
I
from your
think it is
perspective.
moving into the right direction. I think the meme coin cycle is really just as a result of the same product market fit that crypto found back in 2021, which was speculation. DeFi, NFTs, meme coins are all kind of going back to that same product of speculation. Now, I do think that we're seeing adoption when it comes to non-speculative use cases, but the adoption curve is much slower. The adoption curve with speculation is fueled by this feedback loop of outsized returns, drawing more people in, and so on and so forth. But the adoption cycle, when we're looking at real world transformation, I think is different. And I do think some DePINs like Helium are starting to reach that adoption. I mean, being able to offload, I think, is adoption. Whether or not that's the same level of adoption as speculation, probably not. But I have more faith in it being longer lasting than speculation. Now, speculation will always be there and may always be the primary product market fit for crypto projects. But ultimately, I think the incentive alignment or the power of adoption within incentive alignment is far more broad reaching. It's just harder to get adoption there. It takes longer, and it's not as much of a hockey stick growth pattern. But I do think that that's where the sustainability comes from.
For almost the entire time I've been in this space, I got in 2017, and Ethereum to me always sounded nice on paper, a programmable money, smart contract functionality. And we saw, as you were just mentioning, over the cycles, we've had these speculative sort of bull bust cycles with NFTs, with meme coinery, even with food coin summer and DeFi summer. And it wasn't until this year when, for the first time ever, a real world use case for the value that Ethereum as a network and maybe even ETH as an asset started to play out. And that was largely when when BlackRock launched its BIDL fund, and we started to see these TradFi institutions tokenize their assets. And now these assets are starting to live on Ethereum amongst other networks. But as we also start to talk about L2s and settling onto Ethereum, maybe as a data availability layer, we're going to possibly see the ship turning around of the L2s being a vampiric effect on Ethereum and the ETH asset itself. And as we have something like based rollups start to take effect, where Arbitrum, Base, maybe even future Fidelity chain, JP Morgan chain, they have their own L2s, but they settle on and they leverage Ethereum as the security network. Are we moving to a place where Ethereum as a blockchain network, as an L1, can start to provide a real world use case for L2s, can really start to drive actual activity that's a necessity, and maybe even remove some of the speculation from ETH as an asset? And are we entering a phase where ETH can have utility, and maybe even just maybe, because of market demands, we can see supply-demand cycles pushing the price of ETH as an asset up because the market demands it for utility?
Yeah, I think that's absolutely right, Dylan. I think ETH as an asset is changing fundamentally. So I've wrote an op-ed on this actually, which should be going out in the next few weeks here. But in a way, Ethereum's already kind of won. It's become the de facto platform for asset issuance and on-chain finance and smart contract development. I mean, Solidity is still in the lead there. Now, is it the best? Probably not. But it's got that market traction. It's got that adoption. It's got that buy-in. It is heading towards a strange paradox in the sense that Ethereum is going to be everywhere, but it might not be the thing that anyone's excited about at any given point. And depending on your perspective, that's either its superpower or its biggest weakness. So I think, yes, Ethereum is moving towards being a full just DA layer. And I don't think that the roadmap is particularly shy about this either. I mean, the goal from what I can gather is to strip down the base layer to its bare essentials of things like finality, settlement and data availability. And then the L2s, whether they're base rollups or whether they're optimistic rollups, hopefully not, whether they're ZK rollups, execution, state, data, computation, everything is offloaded to these layer 2s. And so the enabling technology, I think, is really lying in zero knowledge rollups. I think we're seeing the Ethereum Foundation start to prepare for this as well. I mean, the RISC-V framework that came out of Vitalik's proposal, I think, is indicative of that kind of an environment where the base L1 is just proving. But I think this environment positions ETH as an asset in an interesting way, because things start to look less certain for ETH as an asset. Post EIP 4844 and blob space being introduced, we had this introduction of a separate lane of bandwidth dedicated for rollup data. And they obviously made gas fees lower, both for the user and for the rollups, but it changes Ethereum's demand drivers, I think, pretty fundamentally. Blob space has now created this new hard to price asset, and the demand curves are pretty nascent and unpredictable. And so ETH as an asset has started to change, where before it used to capture, I mean, it still captures a lot of fees through EIP 1559 and gas fees, but demand for transaction execution and blob space. But the demand for blob space is going to have far less of an impact on the demand for ETH than demand for L1 execution directly. I mean, gas fees were pretty high, right, on the L1. And so ETH as an asset needs to change. Does ETH look like a low volatility bond in the future with staking rewards? Are we going to price it off of the future staking rewards? Does it behave like AWS bandwidth, where you want access to the bandwidth to be able to post onto L1? Does it even remain the centerpiece of Ethereum's economy? And I think these are the questions that ETH needs to answer, in the sense that, how do they want the users to engage with ETH? What is ETH going to be representative of? And what can ETH L1 DA provide that others can't? What's kind of the feedback loop that keeps users coming back to ETH L1 DA as opposed to something like Celestia? I do think there's something there, whether it's state reconstruction from the L1 for interoperability across different L2 environments, where you have kind of a global state across all L2s. I don't know what it may be, but I think there's something there to allow ETH DA to kind of pull forward.
Yeah, that's kind of the thesis that I choose to be bullish on, something similar to that. And as you brought up, EVM is kind of king right now, and Solidity's king. So Ethereum has this opportunity to kind of leverage all these side networks that are building on top of EVM, and it can really act as kind of the unifying factor for them. But in 2021, I had this kind of modular versus monolithic argument internally, and it feels like it's starting to reemerge in 2025, particularly as we saw a lot of success with Solana from gaining new developers, from gaining traction on new projects, from seeing projects leave other ecosystems and choosing to build on Solana. So we really now have, once again, this kind of emerging debate. Is it going to be a monolithic network that sort of takes off and takes all? Or are we really going to see this value in modularity really start to take off? And from my perspective, it can go either way. We can have these TradFi guys building EVM L2s, or we can have these kind of like large-scale corporate entities choosing to build within a monolithic Solana-like entity blockchain network. So where do you view today in 2025 this debate between modular and monolithic? Is it even a thing?
Well, I think in infrastructure design, it is a thing, but only in the sense that modular systems give you more composability. So yes, Solana's largely a monolithic structure, but even Solana I see moving towards more modular type systems. So earlier we saw network extensions coming out of Solana, and I would consider BAM like a bit of a continuation of that. I don't know if you're familiar with BAM, the things that came up pretty recently. It was a Jito live stream where they were talking about BAM, essentially. BAM is new to Solana, but it's kind of in that same direction as network extensions, Solana's version of layer 2s in a way. But I think that if institutions are getting involved with blockchains, to the extent that they go with a monolithic system, if they want any sort of composability with their own existing systems without having to integrate everything, or with other potential systems that could exist, they're going to need some modular infrastructure piece to make those two systems composable. And I just don't think that you have that same level of extensibility in fully monolithic systems. Now, does that distinction even exist anymore? Is a good question. I'm not sure. But I do think that institutions will always have to lean on these modular infrastructure pieces to fully achieve the goals of what they're trying to achieve.
Zooming out, wrapping up, final question. I understand this might kind of like be a big, I don't want to say curveball, but this is a big question. So looking back on your experiences as a researcher from 2017 and drawing from all the promises that have been made each cycle and just like earning the cynicism for seeing what has worked and what has failed, I honestly feel like 95% of these dreams that were sold to us have failed and maybe 5% have stuck. Drawing on this experience and still being here 8+ years, how do we take the lessons we've learned since 2017 and apply them to maybe some heuristics for our 5-year roadmap? And can you use these lessons learned to maybe create a 5-year vision for where you think we're going to be as a blockchain industry in that time frame? And I know that's a big, heady question, but I feel like as a researcher, you're going to bring some fire.
You know, every cycle we were sold a dream. 2013, Bitcoin is daily money, going all the way to, 24 agents, AI agents. But I don't think that they failed because they were wrong, but rather that they were premature or misaligned at the time. And so I think one of the biggest takeaways for me personally has been, number one, tech alone is never enough. What we can do on a technical basis and the market transformation that we can theoretically bring about as a result of technical innovation is not everything. We can't rely on the tech alone. Code is easy, distribution is hard, generally. And so I think it's important to always think back to that. I mean, there are so many different examples that we can lean on. If we look at the bridge wars, for example, like, did the tech win or did the distribution win? I think the second piece is token doesn't necessarily mean product market fit either. Airdrops don't mean retention. Yield doesn't necessarily mean utility. And so I think real usage or real PMF in crypto still should look like organic usage with aligned incentives. Stablecoins in emerging markets, for example. Sure, speculative markets to the extent that people want to speculate. Yeah, I think being able to lean on product market fit outside of tokens. Cycles, I think, also kill nuance. Like, a dream is sold to us. People get behind this idea and they get behind it so much, so quickly in such a short period of time that the narrative gets overfit with short-term speculation. And I think that can kill the adoption lifecycle that, the best builders often do go through, which is, quiet during hype and reemerge with a product that is just superior to any other. If I'm thinking about a 5-year roadmap or plan, invest in things that make sense in a distributed fashion without a token first. And a token could really accelerate the adoption. Tokens should enhance, not, justify the product. Bet on products that can survive a US ban or a, regulatory blowback. While we might be in a favorable environment now, that may not always be the case. And so censorship resistance, I think, is important to not lose in the context of being compliant and approved from a regulatory perspective. I do think that things like ZK Compute do need to go through some level of acceleration for viability, and some level of adoption will rely on our ability to accelerate the viability of these technical pieces. But I think that's just a function of time. But I mean, in short, to try and answer your question, instead of us promising another 10x without the learnings of the last decade, I think the grounded vision for crypto should be, it's not just financial infrastructure, but it's digital public infrastructure. something that's credibly neutral, globally accessible, and resilient to collapse. And only on those sort of premises can you actually go through the Darwin cycles of applications dying and living and being able to survive in the long run. Because unless you have credibly neutral, kind of globally accessible infrastructure to build it on, it's not going to be a reality. That's why I do think modular systems work well. Modular block space, price like AWS bandwidth makes sense, because it's about what are the building blocks of that future going to look like. That's where a lot of the things like decentralized provenance, identity for the login layer, like we don't know what it's going to look like, but we can take a guess looking at that future vision of what should that global public accessible infrastructure look like.
Fantastic conclusion. Aryan, if anybody listened to this and is excited to reach out to you or to CMT Digital, what's the best way they can contact you or reach out to the team?
Yeah, you can just ping me on Telegram. I'm Persian Pariah. I'm an immigrant from Iran originally. That's why.
Awesome. Well, Aryan, thank you so much for your time today. I had a blast. Thanks for talking everything macro and policy and getting into the weeds of outlooks for networks and architecture themselves. I really appreciate the time you spent with us.
Thank you, Dylan. Likewise.
Cheers.
Cheers.
Thank you so much for tuning in to the Smart Economy podcast. To stay in the loop with all of our latest episodes and insights, head over to www.smarteconomypodcast.com. And don't forget to subscribe to our YouTube channel for all of our video content. If you enjoyed today's discussion, please consider showing your support by liking, commenting, and reviewing this episode on your favorite podcasting platform. Your feedback helps us reach more listeners and bring even better content your way. We'd also love to hear from you, so drop a comment on Spotify or YouTube to share what topics you'd like to cover us. We'd also love to hear from you. So please drop a comment on Spotify or YouTube to share what topics you'd like us to cover or who you'd like to see as our next guest. And if you or someone you know would make for a great guest, don't hesitate to reach out. We're always looking for fresh voices and new perspectives. And for our NEO token holders out there, please consider voting for NEO News Today as your council representative. We've proudly been serving the NEO ecosystem since 2017, and will continue to do so by putting portions of our council rewards directly back into ecosystem growth initiatives. So, with all of that said, thank you once again for listening to the Smart Economy podcast, and we look forward to catching you next time.